customers, clients, consumers, and other people that associate with the business may find this not reasonable, and for that reason they can decide to part ways with the company, and as such the company may start losing revenue or will have to close down. Another reason business can fail is where they lose their major raw material suppliers. The loss of major raw materials needed for its operation. When the raw materials needed for production or operation of the business is no longer available, then the company will actually fold up. Another one is complying with the order of the court through an application by the creditors or debenture holder of the company. That is, they can wind up by court order. By court order to close down. When the court made pronouncement or judgment that the company should fold up, then they would have to fold up, probably when the company is having insolvency or they are not able to meet their obligations to the debenture holders or creditors as they fall due, then it would have to fold up. Another reason business can fold up is where they lose market share, where they have lost their market share. That is, in the market where they used to be the major stakeholders or the market leader, if there are competitors that actually chase them away, or there is a major competitor that client or customers now prefer to the company, then it's going to be a big problem. It can lead or result into their closing down. Another reason why a company can fold up is when they have liquidity problem. They can no longer meet short-term obligations as they fall due. They are unable to pay wages and salaries. They are unable to meet suppliers' needs. They are unable to pay their liabilities as they fall due. Customers are not paid on time. Employees are not paid. Short-term obligations and other liabilities are not met on time. Then the company is at the verge of closing down. Then when they continuously make loss, continuous decline in profit, when the profit of the company is dropping or they are making close to loss or zero, then the company can fold down. Another reason why business can fold up is where we have unfavorable government policies. Unfavorable government policies. Another one is political instability. And all sorts. Okay, moving on. I haven't discussed some of the reasons why business fold up. Let us look at some of the provisions of the Act. Initially, I mentioned a section of the Act, section 20, subsection 4 of Peter, and subsection 24, section 24, subsection 4 of CETA. What does the Act say? The Act says when a business permanently fold up or ceased operation, the penultimate year an ultimate year must be established. Now, what do we understand by the penultimate year? The penultimate year is the year preceding the year of cessation, and it shall be assessed to tax on both preceding and actual year basis. It should be noted that the tax authority will pick the computation that will generate maximum return to them out of the two. Penultimate year, then the ultimate year. This is the year in which the business actually ceased its operation permanently and is assessed on to tax on actual year basis, that is from 1st of January to the date of cessation of the same year. Now, what does this provision is actually says, or what this actually talking about? If we are going to tax a company that folds up, we need two major years: the ultimate year, the ultimate year. The ultimate year is the year the company finally and permanently closed down. And if we're going to assess the company to tax for that year, we will assess the company to tax using the date commencing from the year 1st January of that year to the date the company actually ceased operation. So if the date the company fold up is March, we will assess to tax the company from 1st January of that year to 31st of March that year. Now, in the penultimate year, which is the second year we are looking at, penultimate year, the penultimate year is the year that comes immediately before the year the company folds up. So if a company folds up in 2010, the penultimate year will be regarded as 2009. That is the penultimate year. Now, for the purpose of tax, if we're going to assess this company to tax in the penultimate year, we are going to consider the higher of these two. The higher of actual year basis, that is the 1st January of that year to 31st December of that year. This date is usually known as government accounting date. I've explained this in our accounting year and fiscal year. 1st January to 31st of December of a particular year is regarded as actual year basis. And if we're going to consider the company on preceding year basis, if we're going to look at preceding year basis, we're going to use the accounting year end of the company. Accounting year end of the company. Whichever of these two that gives us the higher or the maximum revenue is what the tax authority will consider, and we would assess the company to tax on this basis. So anything after the ultimate year, the business is usually regarded as dead. Now let's take an illustration to buttress this analysis so you can understand well what we are talking about. Habims Limited decide to fold up its operation with effect from 31st of May 2012 as a result of difficulties in getting enough contracts. Using the information below, you are required to determine the basis of assessing the company to tax. And not just the basis, we will calculate the assessable profit. Now, the company is actually ceasing operation by 31st of March. So our ultimate year, the ultimate year is 2012. Then the penultimate year will be the year before this date, that's 2011. So if we're going to evaluate the company, Abems Limited, computation of assessable profit. Now, for now, we'll be looking at only 2011 and 2012 year of assessment. Now, starting with 2011 basis period, let's year of assessment, basis period, then assessable profit. Now, in 2011, which happened to be the penultimate year, remember the rule says the company should be assessed on actual year basis and preceding year basis. In this case, the company makes up its account to 31st of October. So we're going to consider 2011, the account will be 31st of October 2010, because we are using preceding year basis, and this was started from 1st of November 2009. This is actual year basis. Now, looking at this date, the profit for that period ended was actually given as 388,800. 388,800. Then, if we are to consider the company, this is preceding year, not actual. This is preceding year. This is preceding year because I'm using the company's accounting date. Now, if we're going to use the actual year basis, we'll consider 1st of January 2011 to 31st of December 2011. And remember, I told you under the commencement rule that if you're looking for a date, all you need to do is to look at the question and see where the first date can actually fall within. Now we have the date 1st of January. Where can we get 1st of January in this question? This profit of 2011 must have started from 1st of November 2011, ending 2010 rather, ending by 31st of October 2011. So we'll have to get 10 months out of this. 1/1/2011 to 31st of October 2011. That's a 10-month period. The 10-month period out of 12 months times 216,000. 216,000. So if we are going to do this, it gives us that will give us 216 216